This is Eric Mwathe with Mwathe.com with a weekend market analysis for February 23rd and 24th, 2019 with a couple of seconds before the market close. And here's the close. We'll let the numbers settle out and we'll see what the market is going into the weekend looking like from a technical standpoint. We can see here for the day, S&P 500 was up close to 0.64% for the day. For the week, let's take a look at the weekly gain. And for the week, S&P 500 was up 0.62%. For the week, the Dow was up 0.58%. And for the week, the Nasdaq closed higher at 0.74%. From a newsworthy standpoint, the Nasdaq and the Dow have now staged 9 straight positive weekly gains. Positive to the upside. That's very impressive. And that's how the Nasdaq looks on the weekly. Take a look at the Dow. Similar situation here, 9 straight weeks to the upside. S&P 500 took a break after 4 weeks of gains and then moved back higher. So it's been higher 8 of the last 9 weeks. Pretty impressive all the same. Now, if we can consider something here on this chart, using hindsight, we can see that on hindsight, this was a trap for bulls. On hindsight, this was a bearish trap. And if we take the closing on a weekly basis, take this high on a weekly closing basis, and this low on a weekly closing basis, going back to early 2018, just do it like that, we can see that pretty much we are within this box where we've been trading going back to early 2018. A lot of volatility, but net still within the box. Now, unlike the 2017 bull market run here, which on hindsight is very smooth, very tight ranges, you can see that over the last year or so, this market has become very volatile. Very hard to peg direction. And I would suspect that this volatility that we've seen is pretty much within the box, has not ended. So it would not surprise me that there's still going to be some volatility in the coming weeks based on behavior the market has pretty much observed and recorded since this close here of early 2018. I would venture to speculate that this is more of a bearish pattern than a bullish one. Because generally when you're seeing a good base and an explosive run, that tends to hold. But when you see something like this all over the place, it tends to resolve to the downside for the most part, because one is stable, the other one is unstable as a formation and a base. Which, by the way, brings me to a stock. Let me just get out of line here and digress a little bit out of topic. But this is Tesla on a 2-year weekly chart. And just using Tesla here as an example, we can see that it's been stuck within this very unstable and volatile weekly behavior. Pretty much almost impossible to peg direction here. This is just all over the place. And I would guesstimate not much is going to change in the coming weeks in terms of this type of behavior. What it might take is either a massive breakout outside of this box, or at some point a breakdown below this range to begin a massive move lower. But this is very unstable, highly unlikely you get a bull run out of this. Now we go back to the market, and it would seem to me that this choppiness, as far as S&P 500 is concerned, I don't see how it just comes to a stop. So this volatility, in my opinion, in this box is to be expected. But we shall see. Now, let's take a look here at the technicals. Begin with the RSI. Last week I was pointing out the possibility of resistance on the top side. If you take a look at the recent highs of the weekly chart here, and now within range here. So of course the question is, how is it going to behave around this level? Resistance on the red line does hint at the possibility of stalling around here and a pullback. And of course, bulls would like to see the market clear this level to advance the recent market recovery of December lows. We can also draw this line here, which represents the break of the highs. We can draw a line, should be around where we are trading, something like that. So the market would also have to clear the blue line if it is to move higher. Incidentally, if we backtest this blue line here, I would say the market is aware of the line, because here we move above it for this breakout level. We show resistance here during these two highs. So for this market to advance beyond current price levels, we would eventually have to take out that line before we can move higher. On the daily for the S&P 500, as long as the S&P 500 is holding above 69.1, expect the market to continue staging stability, if not on a daily basis, even pick up momentum. So the more the RSI is above 69.1, expect momentum to pick up to the upside. It would be similar to this period here, where the RSI jumps above 69.1 and the market would pick up momentum in the early part of 2018. In short, anything above 69.1 is what the bulls want to see and is bullish. One can expect continuation of momentum. If the market is unable to sustain levels above 69.1, if we end up rolling over around here, then that starts asking questions about the market, and we can use that as a reason and a setup to anticipate lower short-term prices. If we take a look at the 2 hourly for the S&P 500, we can see that the market, in my opinion, looks like it is preparing for some movement. We can see narrowing of price action. Should be something like that. The RSI is also telegraphing something similar. We got bottom side support, top side resistance. And so clearly here, what the market would need to do is blast above this range to stage a continuation of the recent move. Alternatively, we might see a breakdown below the wedge in terms of price wedge and RSI wedge, and that could begin the short-term pullback or a major pullback. Depends on how the weeklies and the monthlies turn out or take shape. So here looks like we are kind of narrowing into a short-term decision. Whether we are going to get a breakout or a breakdown is anybody's guess at this point, but we'll have to wait for the market to lead us into what should be the next meaningful direction. Do enjoy the rest of your weekend. For paid subscribers, let's continue on.